Citadel says it sold more than 80% of the risk it had just bought in 3 weeks. $16 billion of a forced seller's stock portfolio purchased at a 10% discount on the 30th of July. By the 21st of August, Ken Griffin's own letter says that the firm had shed more than 80% of that risk using nearly 100 separate block trades. The market called the entry conviction on artificial intelligence infrastructure. Here is the question this film answers. At what point does calling an entry conviction stop being marketing and start being a fact you can check against the trading tape yourself? 4 dates line up first, 3 weeks apart, telling one story. On the 29th of July, the Federal Reserve holds its policy rate. On the 30th, Citadel buys the block. On the 14th of August, a regulatory filing confirms exactly which stocks were in it. On the 21st, Griffin's own letter names the exit. Here is the sentence that matters. From that letter, reproduced identically across 3 separate financial outlets within hours. Our ability to distribute this risk was central to our investment thesis, Griffin wrote. These moments highlight our ability to deploy capital with speed and conviction. On the day of the trade itself, 4 names in the forced seller's book ripped between 21 and 28% in a single session, which is the kind of move that gets read one way and one way only. The market called it Citadel underwriting an artificial intelligence infrastructure trade with its own balance sheet. I wrote about the mechanics of that exact session 3 weeks before this letter ever came out, and one detail from it still holds up under everything Griffin has since said. A name that never once appeared in the forced seller's disclosed holdings rallied just as hard as the ones that did. The backdrop is what makes the conviction story easy to believe. The forced seller had returned 439% through the first half of the year on leveraged artificial intelligence bets, then lost roughly 67% in July alone as 2 of its largest positions fell by half. Assets collapsed from as much as $45 billion to roughly $10 billion in a matter of weeks. 3 prime brokers, the banks financing the fund, had already issued margin calls, and the book was being shopped around Wall Street with nobody willing to step up. Then, the very morning after the Fed held rates, Citadel bought the whole thing in one single block. Griffin's own words at the time reinforced that reading. Citadel described itself as front-footed over nearly 36 years of history, arithmetic that checks out against a firm founded back in 1990. A firm that wants credit for a fundamental call talks exactly like that, in public, right after the trade. I am not going to argue the conviction reading was foolish at the time. My claim is narrower than that. It was incomplete, and Griffin's own next letter is what closes the gap. The single word doing the work in that August letter is distribute, not hold. One verb, and that is the entire disclosure hiding in plain sight. Citadel is not telling its own investors it bought conviction in memory chips, data center capacity, or power generation. It is telling them, in its own language, that the thesis was the transaction itself. Buy a forced sale book at a discount nobody else on the street could underwrite in the window available, then sell it back into a market that had time to normalize. The receipts back the letter up. Griffin says Citadel completed nearly 100 block trades worth more than $4 billion in market value, including the largest intraday block trades of the entire year in 10 separate names, and shed more than 80% of the aggregate risk it had taken on. Those 2 figures describe entirely different things, and the letter itself never reconciles them. $4 billion transacted is one number. 80% of risk is a different number entirely. Citadel does not publish how it weighs the second against the first. What makes all of this checkable beyond merely plausible is the forced seller's own quarterly filing. Its 5 largest disclosed positions were the exact same 5 names that multiple outlets independently report Citadel bought out of 10 total names. The letter says the block trades spanned. The forced seller's own filing and the forced buyer's own trading tape line up on the same 5 names in the same order of size. I do not read that as a coincidence worth a footnote. I read it as confirmation. A 1988 result from the Journal of Finance is the right frame for what happened here, and it is the reason I keep reaching for it. Market liquidity is nothing more than the demand and supply of immediacy. A market maker gets paid for bearing risk during the interval between a seller who absolutely must transact right now and a buyer who has not yet shown up. He is not being paid for being right about the underlying asset at all. He is paid specifically for standing in that gap. Citadel stood in exactly that gap on the day of the trade. The forced seller needed to sell an entire book, longs and shorts together, before its next margin call arrived. The natural buyers of levered artificial intelligence equity were the other funds running the identical trade, nursing the identical July drawdown at the same moment. The bid did not disappear because the underlying stocks were suddenly bad businesses. It disappeared because everyone who would normally set the price was impaired at the exact same time. A pure liquidity trade carries a specific, falsifiable signature, and it can actually be tested. A short holding period. Returns uncorrelated with the asset's own catalysts. An exit timed to when the forced sale discount closes before the underlying story ever gets the chance to play out. That signature can be checked directly against what happened in the 3 weeks after this exact trade. One of the 5 names posted a strong earnings quarter just 2 days before the block trade closed. A separate company's 43% cloud revenue growth print added roughly $480 billion of market value in a single trading session, landing the very same morning as Citadel's block. None of that is Citadel's own research edge showing up. It is the market's own catalyst calendar, arriving exactly on schedule, and Citadel supplied none of it. That is the mechanism, stated as plainly as I can state it. Citadel captured the reversion, the bounce back from a forced sale discount that never once reflected fundamentals in the first place. The repricing is something else entirely, a genuine change in what these businesses are worth, driven by real earnings and real demand. Citadel captured the first of those two things. The letter never once claims the second. Instead, it credits the trading and prime brokerage desks at the banks serving both firms, a sentence about plumbing, not insight. This also answers a question I left open 3 weeks earlier, and it is worth stating precisely. I wrote then that the real risk in this whole setup is capacity. Levered cohort books keep growing across the industry, and the pool of fast, uncorrelated capital able to warehouse one of them does not obviously grow at the same pace. This episode does not resolve that worry at all. If anything, it sharpens it considerably. Citadel needed roughly 3 weeks and nearly 100 separate block trades just to distribute more than 80% of a single $16 billion book. A regulator with no stake at all in how this story got read had already flagged the exact setup a full month before the margin call happened. Equity prime brokerage balances up roughly 40% annually, the warning read, concentrating in particular sectors, including semiconductors, with an explicit line about cross-market interconnections if funds making losses on equity positions are forced to deleverage. The warning named the mechanism before the mechanism ever had a name attached to it. One number changes how impressive this whole episode actually is. Citadel's commonly cited $71 billion of investment capital is not the figure that actually governs a trade this size. Its own regulatory filing, submitted to the SEC in June, reports $570.6 billion of discretionary assets under management. Against the headline figure, the distributed book is close to 6% of the firm, which sounds large. Against the real regulatory figure, it is roughly 0.7%, which barely moves the needle at all. Both of those statements are true at exactly the same time. For context on how the rest of the firm actually did that month, Citadel's tactical trading fund returned 11.1% in July, and its equities fund returned 14.1%, both comfortably ahead of a rival multi-strategy shop's 5.94%. That tells me the flagship fund's headline month leaned on this one single trade harder than on any other position the firm held that entire July. Here is a fair objection, and it deserves a straight answer. Maybe Citadel simply ran a profitable trade well and took profits exactly on schedule, the way any disciplined desk would. Selling into strength does not automatically mean the original buy was insincere. I take that objection seriously enough to name precisely what would separate the two readings from each other. First, look at the pace and pattern of the exit itself. Ordinary profit-taking on a genuine conviction trade is name by name and catalyst-driven, trimming the position whose thesis has already played out fastest. Griffin describes the exact opposite of that. 10 different names hit their single largest block trade of the entire year together inside the same 3-week window. That is a programmatic, size-driven unwind of one entire inherited book, treated as a single position instead of 10 separate investment calls. Second, look at the language itself, word by word. Nowhere in the reported letter does Griffin claim Citadel's own analysts identified mispriced artificial intelligence fundamentals before anyone else on the street did. The entire quoted passage is only about risk assessment speed, capital deployment speed, and execution precision. A firm proud of a genuine fundamental call talks about the call itself. A firm proud of a liquidity trade talks about the execution. Griffin talked at length about the execution, the way Citadel talks elsewhere about a strategic stake it actually intends to hold. One flag before I lean on any of this further, because it cuts directly against my own reading. An investor letter is a marketing document. It is not an audited record, and this entire piece rests on one sentence pulled from it. The letter reached 4 separate outlets within hours, staying nowhere near private the way most limited partner mail does, and that timing is itself consistent with the marketing reading, on top of being a caveat. I want to be completely honest about that. This is inference, and I would rather say so plainly than dress it up as proof. I do not actually know who bought the other side of Citadel's roughly 100 block trades. Block trade terms are never disclosed publicly, which means I cannot separate durable, long-term holders from momentum capital simply chasing a headline that said Citadel stepped in. That single unknown bounds every conclusion in this piece about who actually benefited once the reversal happened. The forced seller's own leverage makes a clean reading harder here too. Its buying was reportedly as much as 4 times its own capital on the way up, which itself inflated these 5 names well before the July fall ever started. Some meaningful part of what Citadel bought at what looked like a 10% discount was actually a discount to a price the forced seller's own leverage demand had helped create in the first place. That is a real complication, and I am not going to explain it away. There is a sharper version of this same objection, and it earns a straight answer too. Citadel runs hard drawdown and concentration limits on every individual book inside the firm. A single inherited position this large and this correlated would likely get trimmed fast on risk grounds alone, regardless of what anyone at the firm actually believed about the underlying names. From outside the firm, that risk management process looks completely identical to a premeditated distribution plan, and I cannot fully separate the 2 explanations from public data. None of those 4 weaknesses touch the 2 facts doing the real work in this piece: the letter's own words and the 3-week turnaround on more than 80% of the position. Both are public and both are dated. The forced seller itself is still standing today, holding roughly $10 billion, including a private stake it never sold. This is not a story with one clean loser and one clean winner. It reads closer to a fund that survived a margin call by paying a toll, and a toll collector now telling its own investors exactly how that toll got collected. Here is what the lag actually cost the people who acted on the headline instead of the trade. Citadel bought this book on the 30th of July at a discount most of the market could not even reach. By the time retail and momentum capital could act on the Citadel stepped-in headline over the following 3 weeks, Citadel was already the seller on the other side of that exact same trade. One of the 5 names alone added as much as 80% from its lows by the 17th of August, and every dollar of that premium belonged to whoever held through the reversal after Citadel finished distributing. Here is exactly what would prove me wrong, dated and checkable in public. Citadel's next quarterly filing, due by mid-November for the September 30th snapshot, will show what the firm actually held roughly 6 weeks after this letter went out. If that filing shows Citadel rebuilt a meaningful long position in any of the 5 names instead of sitting on the roughly 20% residual that more than 80% shed implies, I am wrong about what this trade actually was. One honest limit on that test: the filing only captures long equity holdings, so conviction expressed instead through options or swaps would not show there either. The next forced book will not look identical to this one on the surface. The underlying mechanism will. A levered fund blows up somewhere. a solvent buyer with clean capital steps in fast, and the headline calls it conviction, while the buyer's own letter, months later, quietly calls it a fee for time. Read the letter, not the headline. Read it specifically for the verb the buyer chose to use. Citadel shed more than 80% of a $16 billion book in 3 weeks using nearly 100 separate trades. The mechanism is Grossman-Miller liquidity provision, being paid to stand in the gap between a forced seller and a buyer who had not shown up, not a fundamental call on artificial intelligence. The tell is Griffin's own verb, distribute, not hold. Watch the third quarter filing, due mid-November. A rebuilt long position in any of the 5 names proves this reading wrong. Sources and full sourcing on screen now.